Okay, welcome everybody. I think we're live. That looked a little funny, but I'm going to assume that we went live. So welcome. It is a Friday. Glad everybody could come hang out for a little bit. We will be talking about volatility trading, and I'm sure we will at some point be dragged into some political content, but that's not really my thing, but of course it is somewhat, connected to the market. So if anybody has any questions, hey, what about this terrible thing that's happening? How's that going to affect the markets? We can at least have a discussion about that. But I'm going to try to stay on point. And also last week, we had just a bunch of questions. And unfortunately, I had to cut it short. So there was a whole bunch that I didn't get to. So today I'm going to try to keep it very short-ish, you know me. And then I'm going to leave plenty of time for the open Q&A. So if you do have questions, the earlier you ask them, the more likely it is that I'll get to them. But the majority of our streams, I do get through them all. It was just a couple of times, maybe if there's some type of super interesting headline topic that we're doing, it attracts a lot of questions. But you can go ahead and start populating that right now. And I'm just going to chat for a few minutes about one very specific thing in VTS, the gold ETF versus the gold miners. This is actually something that will be quite interesting, even if you're not a VTS member. The GDX is an ETF that is, of course, very popular, $25 billion fund. So we're going to be talking about that. And then also just the chart blitz, just going to rip through some interesting things, try to keep them short, but mainly the open Q&A. But I do want to do a little bit of a housekeeping thing, first of all. Just remember that we do actually have a volatility data spreadsheet that people can download, something that I put together and I update it every quarter. I just want to say, because it's the new year, it has actually been updated. So you can go ahead and download that. If you are not a VTS member, what you will want to do is go to the website, of course, go to the subscribe tab. It's going to look like this. And all subscriptions come with a free 2-week trial. So, of course, you can just sign up, get the free 2-week trial. And in that, you're going to get an email every day kind of explaining what we do at VTS, but you'll also get full access to the entire thing. And included in that is the spreadsheet you can download. If you want to know kind of what it looks like, just really briefly, I've just included a bunch of volatility videos sort of in course format. You can just highlight these green every time you complete one. And I just keep adding more and more videos. And then, of course, specific to my portfolio, if you're interested in that, again, I go through all the strategy videos here, and then some other stuff about buy and hold and risk reward. But really, it's the data. Volatility data is actually kind of hard to come by. So I've kept track of everything and I've updated it for everybody. VIX futures, the cash VIX, everybody knows I love this metric specifically. You can do a whole bunch of cool stuff with this data. And then the volatility indexes that all of the ETFs are based on. And these are all back tested back as far as they can go, typically around 2004 when the VIX futures launched. And, this is something that you will have a difficult time finding, but I've compiled it for everybody. Then there's some crypto stuff and whatnot. VIX futures, VIX index going back to 1986. This is some interesting data that people can use for their testing. I've got stocks, bonds, gold, which is essentially just giving you a really solid benchmark that you can measure your investing. And this again goes back to 1990. So this is a 50, 30, 20 all the way back. That is useful. If you're beating this by a significant margin, you are probably quite happy with your retirement account. Crypto data, inflation data. We got a bunch of cool stuff. There's a calculator here. Essentially, it's shorting the VXX between certain VIX ranges. So if you wanted to see what it looks like, if you were to short the VXX daily rebalanced back to 2004, it looks like this, right? Here's the performance, massive drawdowns. But if you were to say, hey, what if I only shorted the VXX when the VIX is over 15 and say under 30, something like that? Well, then you can go and see what the updated sheet looks like. Of course, it looks pretty decent, but there's a massive drawdown there. You will have known if you're a volatility trader that that is Volpocalypse. So you can kind of mess around. It is curve fitting, but it's important to go through these types of exercises in your trading. So, cool stuff there. You've got this updated spreadsheet. Don't save that. And basically it is ready for download. So it's updated every quarter. You can update it yourself, download it once, and then just do it going forward. Or every 3 months, if you really don't want to do it, you can just update a fresh copy. But let's just get right into the first segment. Okay, so GLD or IAU is the replacement that we use. They're basically materially identical ETFs. Why do we have this interesting question about perhaps using the GDX instead? So just to give you a general idea, my portfolio is currently 3 strategies. We will be talking about the green one here, the tactical volatility. Essentially my work, at least with VTS, I do a lot of option trading as well. But at VTS, it's volatility targeting, depending on the level of volatility in the market based on my assessment and my volatility barometer, we'll be using different asset classes. This green strategy, again, is what we're talking about. It is essentially divided into 3 ranges. You can largely consider this a long-short volatility strategy with a pretty comfortable range there of gold. This is the ambiguous range. When it's no longer clear whether to go short or long volatility, we actually just hold gold as a safety position. And this is actually held on about 36% of trading days, as you'll see. So that's why we're talking about this. The IAU works really well for us, but what about the GDX? And the reason this is interesting and why this question is getting asked, this is the last 1 year, and gold in blue here, clearly it's doing very well, up 69% just in the last year. Gold is crushing it. But the gold miners ETF, GDX, this thing is actually up even more, 164%. So this is why the question is being asked, well, if gold is doing so well and this one's way better, surely we should switch it out and use that instead. Now you got to remember that I'm actually not interested in the buy and hold performance of any ETF. That doesn't affect me. It's not a matter of me just choosing the one that performs the best and just shove it into the strategy. All I care about is how does it perform only when I'm going to be holding it, right? I don't care how gold performs when I'm going to be in a very low volatility market holding short volatility. Who cares what gold is doing? I won't be using it then. And again, same thing, when the market is crashing, I would much rather be in long volatility. I'm not going to be in gold either. So I only care about what it's doing for me specifically. So long-term buy and hold, it's actually pretty decent, I guess. Large drawdown there. But again, this is the buy and hold performance of IAU versus GDX. Now, quite clearly, just on a buy and hold perspective, GDX is a wild ride, right? An 80% drawdown. Clearly, we can't use this. But again, I am not a buy and hold investor, so I actually don't care about this chart. What I care about, this is just the IAU gold positions when we are holding it. So our strategy on about 36% of trading days is in safety. And this is the performance of just those positions. So pretty good. This is the time when it is ambiguous, neither short nor long volatility. We're still making a good return with a manageable drawdown. So this is great. So now let's take a look at GDX. This is just a straight switch one ETF for the other. This is GDX in red. Now, this is interesting because it kind of wins and loses at the same time. Clearly, it is a higher rate of return, because gold as a safety position, we are cutting out a lot of these terrible periods. We just won't be holding it during the times when gold is going down. We're only holding it when it's advantageous for us in our specific range. So GDX actually does win by a little bit. However, that drawdown is pretty out of control, to be honest, 50%. Now, some people might think, oh, 28 to 50, it's kind of ballpark close, it might be worth it. You got to remember that drawdowns are exponentially bad. So there's actually a very large difference between these two. If we look at our trusty old chart here, losses are more costly than gains are beneficial. Anytime you suffer a drawdown, so down 30%, it takes you 43% after that to get back to break even. But if you go to 50%, well, now it's 100% to get back to break even. This is going to take a lot longer. So a 50% drawdown, even though it kind of sounds like it's reasonably close to 30, it's really not, because it's exponentially worse. And then of course, if you get to 80%, if you happen to hold something that's down 80%, you can see it could take well over a decade to get back. That's because it requires a 400% subsequent rate of return just to break even. So for me as a trader who, look, I am trying to manage drawdowns as the primary focus. And then when available, I'm trying to short and long volatility to make the money. So our safety position, I don't want to take on additional risk of potential large drawdowns. So even though technically you could make a case that GDX would boost our long-term performance, I am personally not the type of person that would use that. For me, I always have to remind people, when you're, I'm a quant-based trader. Everything is sort of quantifiable and I can analyze the data and it's rules-based and systematic. It's very easy to fall into the trap of looking at a chart and saying, okay, well, here it started and here it is now, and that's an awesome rate of return. I would have been fine. Yes, the drawdown's big, but who cares? It went from A to Z. That's not how real world trading works, though. You have to imagine that drawdown in real time is going to feel infinitely worse than it looks like on a chart. So I have to be, sort of the responsible one here and say, look, I don't think people have the risk tolerance to sustain a 50% drawdown and just wake up the next day and keep trading with confidence. It's probably not going to happen. Mistakes in trading are made when you panic, when you freak out, when something doesn't go as planned. So I don't allow my portfolio to suffer those big drawdowns. It is a safety position for gold. It's not a speculative, make as much money as possible position. So I love the question and this new Versus series, this ETF versus this one. I'm going to do these a lot because these come up all the time and they're always very interesting. But in this case, I think clearly the IAU or the GLD for gold just crushes the GDX, even though rate of return wise, it's a little bit lower. I am a conservative trader by nature, and I will only try to layer on the performance when I've got the risk management taken care of. So GLD in this example is the winner. Okay, so now I see there's some questions being in there. I will get to those in just a few minutes, but let's actually get into a few, hopefully, interesting charts. This won't take long. And of course, I will try not to be too political about this, but it's fun. And of course, like I said, it does affect the economy. So we do have to talk about some politics. But anyway, the first one, this is sort of a continuation of a previous one that I showed where I was actually talking about healthcare premiums. And I was showing that the government has actually been consistently changing the inflation methodology to reflect a number that is significantly lower than what real people in the real world feel. This is why I always refer back to Shadow Statistics. Shadow Statistics is a website that tracks these types of things, and they're not making up numbers out of thin air. All they're doing is using a previous methodology to show what it would look like. And so in this case, based on the 1990 numbers, actual inflation is going to be about 7 to 8%. But the government is saying it's a lot lower. When I did the healthcare one, it was pretty clear, right? Healthcare premiums since 1999, if it tracked the actual CPI, they should have gone up 92% in those, 27 years? But in actual fact, real premiums went up 365%. And healthcare is actually a pretty large chunk of people's household budget. So this matters. Like, doesn't matter what the government is saying, inflation is a lot higher in people's real world budget. Well, another place that this shows up is in housing. Again, housing is a major expense for people. So this is actually really, really important. You don't want housing to be just wildly outpacing inflation. Of course, if you own a house, you're not going to complain if that's the case. But the economy is based on new people participating. It's not a game where you just get a whole bunch of people in 1980 that just jump into the market and buy something, and then we're just going to protect them for the rest of their lives. The economy, in order to keep growing every year, requires new participation every year. And of course, you don't want the housing market to shut people out, despite what you may have seen on social media today with Trump saying that he wants to protect homeowners. I think that was kind of a poorly worded statement, to be honest, but neither here nor there. Anyway, home prices actually in the United States don't outpace inflation by much more than 1%. So it should be reasonably close. But in fact, this is what we see. When we compare home prices, based on the CPI, based on inflation, they should have gone up this much. But you can see, of course, in the 2007, 2008 range, we had a massive housing bubble. And of course, we all know what happened. It crashed back down to baseline. Now, you could certainly make a case that we are also in a massive housing bubble. This isn't me saying that it's going to crash or anything, but it is me pointing out that look, the inflation number, when you actually talk about real world expenses, and we could do the same thing for rent, we could do the same thing for cars, car prices, for education prices, food prices, all of the things that people actually spend their money on are either being excluded or highly underweighted in the CPI calculations to make it look like inflation is low. And why do they do that? Because politicians want inflation to be low. It's good for re-election. This is not an anti-Trump thing. Biden was doing the same thing. Obama, Clinton, go back as far as you want. They want the economic numbers to look as good as possible. So they're in there, they're fudging those numbers, they're de-weighting certain things that are running out of control. Oh, inflation's running, really hot. Let's kind of jig this formula a little bit and make it look better. That's what's actually happening. So some of the largest expenses, like I said, nope, cancel that, including healthcare, cars, all of those things, way, way, way above baseline. So I'm not saying it's going to crash any day now, but at some point this has to give, clearly. Okay. The second thing we wanted to talk about is the imminent government shutdown. Now, I don't know if it's going to happen. It's a changing environment. They're doing meetings. They're making deals. We'll see what happens. But the Kalshi, however you want to say it, the betting market is saying that it's basically we are facing a government shutdown. Now, there's a couple things I wanted to say about this. One of them is strictly by the math, right? When we look at government shutdowns, it's not actually a big deal. A lot of people might think that, well, if the government shuts down, clearly the stock market is going to panic and it's going to crash and we should short the market and make a bunch of money. Well, if you look at this chart, these are all the government shutdowns. I'm not going to say it's a normal thing. But it happens. It's happened several times. Trump's on his what? He's had 4. This might be his 5th. It happens. If you look at the S&P 500 return, clearly it used to be a big deal. But, since 1981, basically, it's actually been a positive for the stock market. So it's not something I'm saying, hey, we should lever up the stock market, but it's not something that people should be panicking. This is something that the government shuts down. The government doesn't. Okay, whatever. It is what it is, which is kind of sad because you would want an economy to think the government shutting down is actually a bad thing, but it just doesn't quite work out that way. So for me personally, I don't think a government shutdown is, bearish equities or anything like that. Now, this is a little bit political. Give me about 5 minutes. Well, let me say 3 minutes to just say that right now the environment out there, the political environment, it's a little bit tough to watch and it's very polarizing. And I'm not going to tell you which side that you should be on, and I'm not going to tell you what side I'm on. This isn't about that. I'm just speaking and getting people to maybe sit back and think, I never quite thought of it that way, right? Because when it comes to U.S. politics, I've always said it's America's, pastime. It's not baseball, it's politics, right? It's 24/7, 365. This is the thing. This is the theater. There's a lot of people who are very hard-lined on either side. What the government shutdown is mainly about, is, of course, ICE, immigration, customs enforcement, whatever. They are rapidly increasing the budget. Now, basically, it's been fairly consistent, but right now, if all the projections of the increases in spending go, ICE will basically be certainly the most well-funded police force in the United States, but so much so, it's to the point where it's basically almost the budget of most of law enforcement in the United States, if it actually comes to fruition. So this is what it's about. Basically, should you fund it? Should you defund it? Who knows? This isn't a real political thing. I just want people to understand that I made a point about this on Twitter recently, and it's just, like I said, just something to think about. I believe this is how rights are taken away. I believe it's a slow process. It doesn't happen overnight, but it's a plan that over time, people don't really know what they're getting into until it's too late, right? It's one of those things where you can kind of read through this. Let's just take an off topic, not about the ICE. Well, it's kind of about the ICE, I guess. But let's say somebody says you have the right to bear arms, right? That's a United States right. You have the right. It's clear. Then they're going to start to say, well, yeah, sure, you have the right, but you still shouldn't do it, right? You shouldn't do this and that with your gun. I mean, that would be irresponsible and reckless. And then the third one you get down to here, as an example, you get someone like Kash Patel going online and saying you absolutely cannot take your guns to a protest, for example. Even though, of course, you can, legally you can, you've got government members saying you can't do this. he's already down on step 3. But then eventually it gets to the point where it's, oh no, by the way, you just can't do this anymore. And it happens slowly and people don't really notice and they give concessions because it sounds reasonable at the time. And then all of a sudden it's not, right? It's kind of like the same thing with gathering data on all of us, right? The AI companies are really good at doing this. They originally started, oh no, of course we don't collect any data, right? And then you find out a little bit later, okay, yes, we're collecting data, but we're certainly not sharing it with anybody. And then a little bit later, actually, guys, you caught us. We are sharing it with people, but we're not profiting from it. Don't worry. Okay, yes, we are actually profiting from it, but don't worry, we're not going to target you with your data. Okay, well, actually, we're going to target you with your data. This is kind of what's happening with OpenAI right now, is that they're basically saying the same thing. They went from saying, we're never going to do this, to now we are definitely going to do this, and it's going to be targeted ads to raise money. So slow incremental changes, and it happens kind of right in front of people's eyes. So what I would say, just for me personally, I'm going to leave you with a quote. This certainly doesn't mean that I'm trying to sway anybody's decision, but I'm just going to read this as an example. Probably some of you have heard this before, but it's a pretty famous quote. It says, first they came for the socialists, and I didn't speak out because I was not a socialist. Then they came for the trade unionists, and I did not speak out because I was not a trade unionist. Then they came for the Jews, and I did not speak out because I was not a Jew. And then they came for me, and there was no one left to speak for me. This is essentially what I'm talking about, is that, again, I'm not trying to sway anybody's thinking here. But if you are one of those people that is saying, hell yeah, this is what I voted for, good for you. Clearly won the election. Free and clear, clean win. This is what you voted for. Great. Would you want President Gavin Newsom doing the same thing? Because you got to remember that if this budget goes from 12 billion to 85 billion, history tells us that the elites don't really give up power once they have it, right? It's not one of those things that they're going to do a job and then that's just, we're going to wrap it up and everybody's going to go home. They're kind of just going to point it somewhere else, aren't they? So you got to ask yourself the question. You might love what's going on now, but like that famous quote says, when they come for me, who's going to speak up for me, right? So I don't think this stuff they're doing with Palantir and the databases, I don't think they're just going to give that up. I mean, the United States is like a 51-49 type of country. It is very likely that the government is going to switch in 3 years. Not guaranteed. Maybe J.D. Vance goes in there and okay, fine. But it is certainly possible that President Gavin Newsom now has an $85 billion ICE budget. Do you want that? It's very possible that President AOC has Palantir database at her disposal. Do you want that? So it's one of those things where sometimes you kind of have to look at it through the lens of, you might love it now because it doesn't affect you, but eventually it might. So just food for thought on that one. I'm somewhat non-political person, but I do like to bring these things up sometimes. Okay, the next thing, and I'm going to actually check the market right now because this is funny, but basically this is the top 20 gold crashes, single day crashes and single day surges going back to 2004, the launch of VIX futures. And let's check the update. This was ugly just before I logged on, and it's even worse. It was 7.5%. Gold is down 8.77%. Let's say silver. It's got to be down over 20. 21.5%. Now, you could argue, sure, this was predicted, right? We've all thought this was coming. I actually did a big gold short recently. I jumped the gun a little, silver. I jumped the gun a little bit, but that trade is already back up into the profit range. I'll actually even show it to you just if you're interested. I just posted this. I call it a lotto ticket trade. It's basically something where you throw out a very small dollar amount. You get it very convex. I only do about 20 or 30 of these a year, and you kind of hope that you hit something on it. So this one was, I threw out a $500 trade. If it pays off and silver actually does collapse, then you can make $9,500. It's a very, very convex trade. And this thing is already up, $1,500 in 2 days. So that's kind of how it happens is, you can see I marked the yellow line where I actually need silver to go in the next 20 days, right? This is a trade that ends February 20th. I've got about 3 weeks to go, but it's already up 200%. It's tripled its value in, 2 days. But anyway, GLD being down 8.45%. Why do I keep opening that page? This one. That actually puts it reasonably close, like top 3 biggest all-time gold crashes. So things are actually starting to heat up. This is just something interesting that I track. It's not really supposed to sway anybody's trading decisions, but boy, we saw gold have an incredible run up, and this will always happen with asset classes. Nothing goes straight up forever. It's just one of those really dangerous games trying to jump in and time the reversal. We all know it was coming. We just didn't know when. Well, apparently today is the day. All right, last thing. Let me just check how many questions there are, and I'm going to try to ballpark my time here. Okay, not too bad. We have time for one more. Hopefully people find this interesting. I certainly do. It's in my sort of wheelhouse here. Social media usage is obviously rocketing, right? We've got people over 4 hours, half the population is on social media. And this doesn't even count Netflix and Amazon and watching television shows. That's like over 8 hours now. We are becoming a society that is glued to our screens, right? And that social media, a lot of it is very short form slop content. So this is something that I certainly pay attention to. I wouldn't say I'm a public figure. I'm not like famous or anything, but I mean, I run a business. I have a YouTube channel. I'm on Twitter, all the things. And as we can see, AI-generated content has now equaled and surpassed human-generated content. And I'm a person, I will die on this hill. I've been talking about it forever, that things like TikTok are dangerous, especially to young, impressionable minds. We are breaking the world with this social media experiment that we're all running here. I think this is a very bad thing. But one thing that I would recommend people do is what I would say is try as best you can to live in the real world. It's going to be beneficial to you the rest of your life. Basically, you've seen a Venn diagram before where you have things that are overlapping. And what I'm talking about today is the overlapping of 3 things. This is where you want to live your life. Trust me, it does not exist inside the screens. So if you divide it into career, relationships, hobbies, essentially what I'm saying is career-wise, you really want to build a personal, in bold letters, brand. Because I believe once all this AI slop thing runs through the world, yeah, it's kind of cool in the beginning, but there's going to be a strong resurgence back to real people doing real work in the real world. People are going to really be put off by all of this AI usage. So I would say write your own articles. I know it takes a little bit longer. I don't use a single AI tool for that. Write your own articles, produce your own videos. Yes, you can use AI tools to make them look a little cooler, but produce your own video. Those ones that are start to finish, it's just an AI. You got to remember that AI is not a thinking machine. It's just an aggregation machine. Everything you put into that machine is going to spit out the law of averages. And even if you have expertise, it's going to spit back something out that's just the average of everybody else's work. That's what it's designed to do. It's not going to be good. It's just going to be a whole bunch of really boring average crap, right? So start a podcast, get your face on camera, speak like a real person. And I understand there's DeepSeek and all these things, but be a real person, personalize your work. As I've always shared with people, you know, I'm a real person in the real world. I share that I was a former professional golfer. I travel the world. I live in Dubai. I live in Taiwan. People can find common ground with me. And trust me, this is not DeepSeek. I am a real person sitting here. I think this is very important for people's career and their life going forward. Relationships, we'll just keep it real simple here. But again, millions of years of human evolution is not going to go away just because we invented a cool new thing. We still need real world interactions. So make sure that if you've got a local pub in your area, hang out with your friends once a week or once every 2 weeks, watch the game, do things like that. As far as AI girlfriends, robots, porn, again, evolution, physical contact is just ingrained in us. And although some of these things might eventually get kind of close, it's never going to be the same thing. So make sure you're focusing on real world relationships and friends. And then, of course, hobbies. Again, you could very easily immerse yourself in the screen world. It's very addictive. The AI slop videos, people just eat those things up. They're high contrast, they're exciting colors, they're cool things that you've seen a lion drinking wine with a, whatever, a unicorn, whatever you can build on these things. It's visually very stunning, but it's destroying our brains. It's the same as short form content. If you spend your time watching 5 to 10 second reels for 3-4 hours a day, you're going to lose the ability to focus on real things, and it's going to start affecting your life. Video games. I'm sorry. I know I'm going to offend a lot of people here, but again, this is a hill I will die on. It is very difficult to succeed in this world. It requires a high level effort, a lot of time, and I just don't think people who play video games are maximizing their probability of being successful. Of course, there's wealthy people who play video games. The richest man in the world is addicted to video games. I get it. But for every one successful person that's a gamer, there's going to be 100 people who just didn't get much done in their life because games are addicting. They're designed to be that way. They hijack your dopamine system. There's always the next level. You grind out your character to get the better stuff. There's always a new game after that. And so I believe, honestly, people should just say goodbye to the video games and focus on real world things, just me personally. And of course, simulating the real world through VR experiences. This is going to get more and more prevalent. Don't do it. Don't do it. Our brains are not designed for that type of thing. We have to stay in the real world. The combination of these three things, trust me, in the next 30 or 40 years, the world's going to be a very strange place. But the people who live here are going to be really connected to what we are supposed to be as people. Honestly, if we could roll back the clock, if I had a button to push and we could roll things back, I'm old, I'm in my 50s. But going back to the 80s and 90s, I mean, trust me, some of my audience might be younger, but those were good times. I'm telling you, they were simpler times and they were good times. And we lived in the real world and we did real things. And I would go back. I'd push that button. So for me personally, I'm on a screen because it's my job, but I really do try to get out of the house. I work out. I go running a lot. I'm getting back into golf. Got to do it. Get offline. Don't spend 8 hours of your day in front of screens and 4 hours on social media. Just don't do it. All right. Rants over. Let's get to some questions. Okay. Could you please walk through how you would initiate a VXX stock replacement trade if you wanted to do one today? The market is quite different from what the video shows. Thanks for all you do. Absolutely. So stock replacement is essentially a way to simulate an underlying stock or ETF with options. So what we typically do, I don't need to show it. You know that we trade the SVXY, for example, in our tactical volatility strategy. Now, the way that this works is the SVXY is a minus 0.5 times leveraged product. The VXX is a 1 times leveraged product. So it's basically double the leverage, but both of them trade the exact same VIX futures. So using VXX put options puts it directionally the same as the SVXY, and then using what we call 0.55 delta put options means that it's going to move about half speed. Now, the reason I say 0.55 and not 0.5, essentially, you would look on the VXX, you would find the option string. I like to go certainly over 100 days minimum. Somewhere around 130 is ideal. The reason for that is that theta on a long put option is going to bleed some of your capital. So you want to push that date out further into the future if you can to get that theta as low as possible. And the reason that we do 0.55, something around this 36 strike, the 35 strike, that's what you'd be looking at because again, that theta might bleed a little bit of that capital. But this position, I'm just going to use the 35. This position is essentially the same thing as holding the SVXY on the long side. So a long VXX put option or just holding the SVXY ETF is basically the same thing. So directionally, it's the same. The way that it moves with the market is essentially the same. This is stock replacement, right? All you need is an ETF with a liquid option market, and you can simulate pretty much anything. Now, the only thing you have to be aware of is that options are extremely capital efficient. So if I were to buy one contract, it would actually only cost me $1,220. But the VXX right now is trading at, let's say, $28, just for simplicity. Well, 100 shares of VXX would cost $2,800, but one contract would only cost $1,200. So we have to actually factor that in. So what I do is I basically do what's called cash secured. And I'm looking at the price of the VXX as my multiplier. So that's $27.50 per 100 shares. That's the capital. So then all you do is divide how much money you want to trade by this number. Okay, that's how many contracts you open. So to give you an example, let's say you had $100,000 to spend on, I'm going to give you a real example here. Let's say you had $100,000 to spend on this portfolio. Well, 33% of it is tactical volatility. So that's what we're talking about right now. You would dedicate $33,000 to this. Now, in order to size it correctly, you don't go in and take your $33,000 and buy put options. That would be highly leveraged. What you do is you divide your $33,000 by the multiplier here, 2744. So all you would do, hopefully people can see this, 33,000 divide by 2744. This is how many option contracts you open. Now you can't open 0.14, so you always round down. This person with stock replacement with a $100,000 portfolio trading my portfolio where only a third of it is here, that person is going to buy 12 contracts. So you would go in here and you would buy 12 of these, and that's it. This is the equivalent trade. And of course, you would want to get the best price possible because it looks like the spread is really large, but in practical application, when you're actually in there trading, it's very easy to get something very close to the mid price. And you can see the volume here is pretty big. That's because we went in a couple of days ago and we bought this contract. So quite a bit of these contracts are the VTS community. But this is essentially how it's done. It's very, very easy to do. It's a simple calculation. Essentially, it's just one additional step. When you're buying an ETF, you just take your capital, divide by the price of the ETF. That's how many shares you buy. When you're doing stock replacement, you just take your capital that you want to spend and you divide it by the multiplier of the ETF, which is just the ETF price times 100, because one option contract is 100 shares of the underlying. That's it. And I know maybe I glazed over that pretty quickly, but trust me, when you do literally just one or two of these, you're going to really understand what's going on. And in the emails, I go through everything in detail, the allocation size, examples, if you have 50,000, if you have 100,000, I make it very easy. So even if you've never traded options before, you can simulate these positions with options with very little effort. I could teach you how to do that in one email. So that's what you're getting at. So today, I would say instead of the 35 that we bought, technically speaking, you might go the 36, but the 35, the 30, anything with an even 5 or 0 probably has even more liquidity. So I would still stick to the 35. 53 delta, it's basically a perfect trade. So how much money do you have? Don't answer that, of course, but you just divide by the multiplier. It's pretty easy. Hopefully that's all clear. Okay, when will you do the versus for the IOIR replacement? Soon. That's a good one. So this versus series, ETF versus ETF, is kind of new, but for everybody who's watching, come back next week. For sure, come back to next week's live stream, because I'm going to be starting a new sort of, not a new series, but every week I'm going to be expanding upon the series, and it's about this subject. I'm basically going to take, I'll show you here, I'm basically going to take the red strategy, strategic tail risk, and we're going to go through all the potential ETF replacements for, first of all, SPY. So short vol, leveraged equities, whatever you can think of. And then IYR is the one that most people are interested in, because this is considered the safety position. And of course, there's a lot that people can think about. Well, what about utilities? What about gold? What about emerging markets? What about the US dollar? What about commodities? There's a lot of things that you could sub in here. And just to be, perfectly clear here, tactical volatility basically never changes. This strategy launched with VTS in 2012 with very, very little change. Defensive rotation, again, nothing changes here. We just added a little bit of what's called hysteresis on just this dial here. A couple articles on the website about what hysteresis is, but basically unchanged. We never adjust these. Strategic tail risk is somewhat of a variable strategy that changes based on sort of every year I analyze the markets and I try to make a little substitutions here and there. I allow myself more changes to this one. So next week, I'm going to start a cool new series. You're definitely going to want to follow along, starting at the first one. That's why I say definitely come back next week. Don't miss the first one. I'm going to introduce it all. Please point to the download of the spreadsheet location. Okay, well, again, I don't love doing this because I don't like my live streams to be advertisements, but in order to get the spreadsheet, it does require you to take the free trial. So if you're in the VTS community already, then you just go to the video library, go to, for some reason, my website isn't loading, so I can't push any of these buttons, but just go to your name and then library, and in there you'll see the welcome package. Just go to number 13. Day number 13, download the spreadsheet. It's all there. It's designed that way so that new people can get access to the spreadsheet. So you have to take the free trial. It is free. Cancel after 2 weeks if you need to. I will not be offended, but you do actually have to take the free trial. And then you're going to have access to what I call the welcome package. It's one video per day introducing everything I do. And one of those videos is the spreadsheet. So you'll get the spreadsheet before you actually have to pay me money, if that, wink, wink, if you get my drift. But feel free to stick around and check out my work as well. The point is that I think once people take a look at what we're doing and look at the portfolio and look at how well protected it is against a potential market crash and how, we're kind of positioned well to play both sides of this, I suspect a few people will stay, but that's what it's designed for. Sorry, a little bit of marketing there. You do have to take the free trial, but you don't have to pay me money. Okay, I just started your VTS. Should I dollar cost average into current holdings or build up cash until there are new signals in the environment? It seems like a breakdown, big, small, is imminent. Yeah, this is one of those. There is a section on the website. I don't know, probably people don't often go to this, but it's called the facts section. Let me see if I can actually get to this. If I click this, it's going to time out. See what I mean? There's something wrong with my website today. Anyway, in the facts section, I literally answered that question directly, but I don't mind doing it again. So long term, it's not going to matter, right? What you do now, it's just going to be a blip on a 20-year chart. So don't put too much pressure on yourself to just make the right decision. I just joined and do I jump in now? Do I wait for a fresh new signal? I don't mean to be callous about it, but do whatever you want. Whatever's comfortable, it's really not going to matter. We will probably exit in and out of these positions. Sometimes it lasts a couple months, but most of the time after a few weeks, we'll eventually take a trade. And you can just jump in then. Or every signal that I give is technically active today. So cost basis doesn't matter. Let's say I've been in something. I've been in the SVXY short vol for like 2 months, and it's very profitable. The trade's going very well. Cost basis doesn't matter. If you get in today and I've been in for 2 months and I'm up money on paper, whatever happens tomorrow affects us both the same. I don't have an advantage over you. Cost basis is an illusion, and it's kind of a dangerous one for investors. They anchor to these prices, and it's not helpful. So I always say, well, yeah, you can just jump in now. Do I know that a crash is coming, or maybe the market is just about to go on a really epic run? I mean, they're choosing the Fed chair soon, and let's say the government shutdown is resolved, but even if it isn't, as I showed, they don't really affect the markets. How do I know the market isn't going to go on an epic run? I don't know if a market's going to crash on Monday or not. So for me to tell you, which one should you do, my signals are active every single day. I check the signals today and send out the signal today. Today, the best thing to do is to be aggressively long the market. That's what the volatility signals are telling us. If you're not short volatility right now, you're not reading the tea leaves in the right way, I would say, or at least in the way that I have had so much success doing it. That's what I would say. You jump in now. If you don't want to, wait a few weeks and see if there's a new trade. It's all the same thing. But yeah, it's all based on you. Again, not to be cold, like nothing matters, but you get my point, is that let's say you make a decision and it doesn't quite work out the way you wanted. It's long-term chart, back up 30,000 feet. You're not even going to notice it. Okay, still curious when you were going to revamp, release the option strategies. Everybody is. It'll happen. It'll happen. That's all I can say is I'm building slowly. Videos are being created behind the scenes. Courses are being built. We are moving we're moving the chains down the field. All right. What happened on paper silver? I woke up half cut. Yeah, well, I looked. It was down, 25% or something like that? Yeah, it's bad. I did have a trade on, so, I can't say I wouldn't love silver to be at 65 in 2 weeks. That'd be pretty cool. But the big swing yesterday meant that some folks needed to adjust their portfolios. There was a lot of leverage in silver. Also, the CME increased margin requirements as of yesterday. I don't know. I don't dig into things like that. I'm not a buy and hold investor. But just one of the things you said there, margin, you do have to look out for that because brokers will sort of strategically adjust margins. This is one of the things that I always warn people against taking bad advice from online volatility traders who tell you that it's safe to short volatility with naked calls or something stupid like that. No, it's not for so many reasons, right? But one of several reasons is because they can just increase margin requirements double or triple. It happens all the time. And then when does that happen? When it's going really badly for you, right? If you're short a UVXY naked call, it's going badly for you when those margins are going to be increased on you. If you're short UVXY or you're short the UVIX or something like that, that trade is just fine when it's working out well. And the brokers are not going to mess around with your trade when it's going well. The time when it's going to be, force liquidated on you for reasons like this is when it's going badly. Silver, on the other hand, is the other way because silver is something that is quite highly shorted, right? I mean, we've known this kind of for years. All the silver people talk about it all the time. It's just being shorted. It's institutional shorting, layering on, manipulation, all these things. So yeah, it goes to 110. They're going to have to get in there and do something because banks will always protect themselves first. They're not going to, they'll give you enough line to hang yourself, but when it starts affecting the probability that they're going to get paid, they're going to get in there and start doing some things to protect themselves. So maybe, and again, I'm not saying this is what happened, but maybe that is certainly something that happens regularly. And when that happens, well, certain institutions with certain trading rules or certain regulations, certain compliance departments, they are actually going to just say, well, nope, sorry, you run out of time, right? You don't get to say, no, don't worry. I know it's going to go back down. Don't worry. Well, sorry, compliance department says you've breached all red flags. You're shutting it down, right? So things like this do happen. Don't know why it's happening, but it was reasonably predictable. When things go parabolic, there's going to be a day where it goes the other way. Trying to guess which day that is kind of a fool's errand. I took a shot, and it seems, at least so far, that it's just starting to work. I need it to go down a little further, of course. I need a little bit of follow through. If SLV could drop another $10 in the next 2 weeks, I'd be pretty happy with that. Sorry if you hold silver, but I personally, please don't martingale. Yes, please don't. I made a whole video about that idiot who was martingaling iron condors. Don't martingale. It's just, it never works out. It really doesn't. What do you think of tactically reducing short vol exposure for the weekend given potential Iran action? Plan to put it back on Monday if indicators still say so. So I understand the general sentiment to this, and I can certainly tell you that there have been times when I have felt strongly that this is the right thing to do. But I have now been trading for 20 years, and I can tell you that there is at least an equal, if not more, number of times where you think something is going to happen and absolutely nothing happens. So if you were to actually plot it on a chart of sort of A/B testing the past, and you were to say every time there's an event that feels like it might be significant, you went to cash, you would lose that game. Long term, you run that experiment, you would lose that game. There would be the occasional times where you're like, aha, I knew it was going to happen. And look at that, they bombed Iran and it's down 3% on Monday. You'll get a few where you're right. But the problem is you're just burning capital every time you're wrong. And you're basically exiting the market when the market trends upward. And you got to remember that the market trends upwards on overnight actions and overnight moves. It's basically a nocturnal animal. It's not moving a whole lot during the day. You need to be holding the overnight in order to make money in the markets. So exiting every time you think something might happen, no. It's kind of like the, random example, but buying S&P 500 put options or holding the VXX long-term, buy and hold. Sure, there's going to be a few times where you just nail it perfectly, but the bleed of opportunity cost and bleeding theta and all these things, the market trending upwards and you're holding the inverse, eventually you just lose your money, right? You'll lose more money on all the times you were wrong than the few times that you were right. And I think that this is one of those things where, could I say that you're wrong? Nothing's going to happen? No. So every weekend something could happen. But I just personally don't do that. Already. Okay, so other conversations, good stuff. Talk to each other. I'm silver swing between 50 and 70 and 150. I don't know what kind of trade covers that size range, but good luck to you. Silver should rip up. China embargo. See, this is the thing about, I'm not saying you're wrong, but silver is kind of like Bitcoin. It's kind of like dividend stocks. There's certain little communities that have these overarching ideas about how this specific asset class works. And you didn't say anything. It just triggered me a little bit. Like there's starting to look like there's some insider lingo going on here. Try to just back up and just look at the world the way it is, right? Trade the market that we actually have, not the one you think we should have, not the one you want. Trade the one we have. Things like just general warnings and stuff like that. Okay, Zionist, A. I don't know if you're talking to somebody else. Shouldn't be talking to me. You really think we're in control? I think you're crazy. Control of what? So what was, I'm trying to, like in a live stream, you try to piece things together based on what I was saying when you made this comment, because I don't look at it live. I do my presentation and then I read the comments a little bit later. So I don't know. Maybe I was talking about the ICE stuff and then, or maybe you're just talking to somebody else. Sorry. You can give more context and ask again. I'll give it another shot. There's not political alternative on US. All of the pocket of donor class and the kosher sausage. There's not political alternative to you on US. Yeah, this is the problem with doing lives where, there's no perfect way to do it. I've done live streams where I don't do any presentation and I just open it up to questions, but they come in slow and you kind of just sit there and go, anybody else got a question? Kind of like that. So I like doing the 20-minute presentation of something while people kind of settle in, get their drink, start asking the questions. But it also means the downside is, I don't know what the hell this means. Sorry, I have to punt again. Will you be looking at SPY versus VOO versus SPYM next week? Maybe not next week, but yeah. Oh, actually, maybe. Okay, sure. I'll throw them on the list for you because like I said, we're going to do the aggressive positions in strategic tail risk. So, you're talking about things that are like razor close in performance. If there's a difference, it's going to be a rounding error. You're talking about just different issuer, SPY and Vanguard, and then the SPY minis. It's literally a rounding error, but sure. I'll just pop a couple charts in there for you. If I see an AI slop in my YouTube feed, I click the 3 dots to the bottom right and select Do Not Recommend Channel. I didn't know you could do that. I avoid AI slop at all costs. I think that we all have to protect our dopamine systems as much as possible. And it is hell trying to reprogram your brain for the real world when you get used to just the ultra visually stimulating things that they're showing us. You can really cook your brain. So yeah, you got to be real careful with this stuff. Grifter. Okay, so now we're getting closer here. This is the same person. I suspect they are marginally illiterate and have assumed I said something that I didn't. And that's cool. I'm totally okay with that label. Hope AI takes over. Gen Alpha is cooked. Otherwise, world falls apart. I am an optimist, and I really do think that more and more people will start realizing what we're doing here. This is a very new experiment we're all running. And I have noticed other countries, certainly the main example everybody gives is China, where they their TikTok is mostly about, engineering and science projects and like sharing history of architecture. And our TikTok is what our TikTok is. There's other countries that have now done, age restricted banning. I personally think that any type of artificial relationship type stuff should absolutely be age gated. I just think that, studies have proven time and again that the human mind is not fully developed until we're well into our 20s. We are exposing literally 12-year-olds to things they can't possibly be responsible enough to filter this out on their own. So we have to be the adults in the room, and we have to do it. And if that means that it feels like we're trampling on a 12-year-old's First Amendment rights, well, yeah, we're trying to build a good world here. I'm personally, I wouldn't say I'm a free speech absolutist and all that stuff. I'm very against government overreach and blocking, and you can't do this and you can't do that. But at the same time, we're talking about 12-year-olds here. If you're 18 and you want to watch slop videos and you want to have an AI girlfriend, and you go for it, bad decision. Personally, I feel bad decision, but go for it. But no, I think the adults in the room have to step in here. And I do think that the pendulum is swinging the other way, where there's a lot of parents out there that are realizing, handing them a screen, handing them an iPad does make it easier to have a nice dinner with your wife, but the trade-off isn't worth it, because now I've got this kid who has a dopamine system that's fried. And even though that nice dinner with my wife where the kid was sitting quietly watching the screens was cool, all the other times where I cannot control this child because they can't focus for 2 seconds, that's not worth the trade-off. So there are parents who are waking up to this. There are politicians who are parents who are waking up to this. So hopefully we get some more responsible things done. And again, I'm not saying adults need to be protected. You do what you want to do as an adult, but got to protect the kids, right? I know that sounds a little corny, but it is what it is. You might just get your wish today. I bet you're talking about silver. It's a nightmare. Down 26.94. I knew it would crash eventually. I think everybody did. I'm not Nostradamus here, but predicting that day is hard. The only public fund investing in silver futures in mainland China, UBS SDIC Silver Futures Fund, a listed open-ended fund, will be suspended for the whole day on Friday. Well, silver's all SLV, and anything related to silver is also going to be halted trading, right? This is an absolute nightmare. Yeah, that's what happens. Do you look at IV skew when doing calendar diagonals? Will something like that skew in your future options course? I don't really look at skew in that way. When I'm choosing calendars or iron condors, what I essentially do is I choose the trades first. I try to choose, high probability trades that land within all of my rules that the strategy has. And then I will expand it to smaller edges. So in options trading, of course, it's all about edges. If you just do this blindly, you'll make zero minus trade fees. So what we're trying to do is add layers of edge, right? Position sizing, reducing trade fees, layering structures, having better risk management, understanding that this trade works better in this environment, and ramp up your trade frequency if you see these 4 conditions, and ramp down your frequency if you see those ones. You can add little edges to make more money long term. And so I start with the biggest ones and I filter down to the smallest ones. So by the time you get down to looking at skew of the actual underlying of the trade that you're taking, you're down to layer 4 or whatever, layer 5 of edge there. It's the same thing when you're choosing an iron condor and you've decided that this is a good trade. You just, do you do it on the SPY? Do you do it on the Russell? Do you do it on the NASDAQ? If you're doing an iron condor, they perform better with higher implied volatility. So you'd look at the SPY, the IWM, and the triple Qs, and you'd see which one has the highest IV, and maybe you'd go to that one. This is a small edge, but it's something, right? So when you get down to that layer, maybe you're taking advantage of this. But mainly you want to take care of the bigger things first, and then go as far down as you want. Every penny counts. So if you find edge in things like that, then absolutely go for it. Have you ever backtested moving to cash instead of SVXY on tactical volatility when your barometer gets super low? Have you ever backtested moving to cash instead of SVXY on tactical volatility when your barometer? Oh, I know what you're saying. Like QL, I should have just finished the question. Like with QLD to cash on defensive rotation. So now I'm going to have to actually get into this hysteresis stuff. So essentially what it is, if you look at any chart, let's take the Qs, the QLD, because that's what we're trading. So my volatility barometer is going to be analyzing volatility metrics. And when it gets into the very low range, we're talking below 20%, that typically happens when the markets are sort of topping, right? So here you might have gone from, because it's just coming off of a market crash, you'll still have higher implied volatilities across the board. And so you're not going to hit that 20% for a while, right? So we rode this trend up and, make some nice profit, but eventually the market's calm enough for long enough that it allows for volatility to get to those low levels. And it typically, not always, but typically happens when stocks are topping. Okay, so we moved out of the QLD and into cash, let's just say somewhere in here. And that's what happens. Markets tend to top with low volatility, and then they're out. So the question is, should you do that with something like short volatility? And the answer is no. And the reason it's no is because stocks are binary. It's long, short. If it goes up, you make money. If it goes down, you lose money. Presumably you're long. Short volatility is not like that. If the stock market stays flat and volatility stays low, a stock position might make no money, right? It's running on fumes. There's no reason to be holding it. We shift into cash. That works just fine. That's what the hysteresis is. We get out at 20, we get back in when it goes over 30. So there's a 10% band there where we're in cash waiting for the market to sort of do something new. Whatever that new thing is, do something new, and then I'll get back in. But short volatility can actually profit when the market is on fumes, because all it is based on the VIX futures. And as long as it's in contango and as long as time is passing, when the front 2-month futures are above the VIX index, they converge down to the VIX at expiration, and SVXY still makes money in a flat market. So you don't want to get out of SVXY during low volatility because there's actually a little more meat on that bone. But with stocks, typically the answer is no. So that's why, and it also helps for diversification purposes when, for example, you've got 3 strategies doing different things, like short volatility here, but a cash position here. We've got a big gold position here, but gold, utilities, and real estate are 3 different positions. And there's even times when SPY and QLD and SVXY totally decouple as well. We saw that recently where our SVXY position was crushing it, right? We got in about there, absolutely crushing it on this latest run up, right? Look at that compared to what the SPY was doing, not a whole lot, right? So there are times when they all decouple. So A, short volatility still works well in low volatility, and B, it is nice to have 2 strategies doing 2 different things. So long-winded answer of saying, no, we do not exit the SVXY. Okay. Brent, remember you at 12. You probably were illiterate. You're probably literate and math proficient. I actually was one of those dorky kids who was like the math geek. What do we call it? Kung Fu math. I was the Kung Fu math champion, where you stand up in front of the room and the teacher just shouts out a long string of calculations and you're supposed to do it in your head. And yeah, I was that dork. So, okay. Point taken. Kids nowadays are cooked. I remember. I'm not that old too. Yeah, I don't know what it is. I think some people are just predisposed to enjoy learning or not enjoy learning. I was one of the ones that was, I valued it, I guess. I don't know why. I just did. So when I look at, my geeky mind now looking at what the youth is doing to their brains, I'm not I'm far from the most successful person out there, but I do pretty well. I'm fairly efficient with my time. I get a lot done. I'm in my 50s and I still find time to exercise and eat right. And I try to do the right things, but I know that I haven't played video games in 30 years, but I know that if I did, it's addicting. I bet you they're cool. I know for sure it's cool. And if I had a video game, I would probably enjoy the hell out of it. I'm not saying that all video games, they suck. No, I'm saying they're awesome. That's why you don't play them, because they're awesome. Because if you're playing video games, they are designed to suck time out of your day. You don't have that much time. Like, a lot of people don't have time to do their work, let alone be a present spouse or present for their kids and throw a baseball with their son, go coach the little league games. These are very time-consuming things, and unfortunately, video games are amazing. And I'm saying that as somebody who, the last time I played video games, I was in my teens, right? I can't even imagine how cool they are now. That's why I avoid games like the plague, because they are strictly designed with billions of dollars of R&D to hijack your dopamine system. They're amazing. I agree with you. That's why you don't take them. You know what? There are some drugs that are pretty amazing too, and they're designed to do the same thing. Don't do it. It's not don't do it because it sucks and it's a waste of time. It's don't do it because they're incredible and you will lose time having no control over it. So yeah, maybe I should have explained that clearer, but protect your dopamine system. Will you have an options course whenever you start offering the options service? The whole thing's going to be kind of packaged similar to what it used to be, just with underlying videos, because we used to have a full separate options community and it was great, and I had shout out a trade every single day and people liked it, but I was just getting bombarded with a million follow-up questions because there was no courses underneath it. It was just, I was trying my best in a day-to-day email system to explain my rationality, but it just wasn't hitting, and my email inbox just became an absolute 5-hour-a-day nightmare, and so I had to shut it down. I didn't shut it down because it was not popular. I shut it down because there was too many people asking too many questions. So the next time I do this, I'm going to open it again with an underlying course for each of the strategies I talk about. And then hopefully I'll be able to say, well, that's a great question. Refer to lesson 4. There's a full video. There's a 5-minute video explaining this, right? That's my goal anyway. I can't guarantee that it'll hit and it'll be good, but that's in my brain. That's the plan. What was signal to get out of QLD? When? The most recent one? The most recent one was up, correct? So volatility barometer, I think it hit 70 intraday. I can't remember what it was in the email, but defensive rotation exits at 66%. So if the barometer gets above 66, it's, if people don't know what the barometer is, let me just take a sip of my coffee here. My VTS volatility barometer is a composition of more than a dozen volatility metrics that combine to be the best representation of overall market volatility that you'll find anywhere. Essentially, I'm data mining volatility metrics to tell me when to hold those aggressive market positions, when to protect my capital and move to safety, and when to flip that switch and actually try to capitalize on a market crash. For example, we'll definitely be shorting volatility. Yeah, you get the point. So defensive rotation exits at you can see here, you can't quite see it, but 20% on the low side, 66% here, 85% switching to cash. And the day that we exited recently, just for that one single day, remember we jumped right back into it the next day, but it was just because it breached here. It's no more complicated than that. Yeah, if it breaches low, it means that the VB went below 20. All right. In that hysteresis article, is that hysteresis an article or video? So go to my website, hit the search. I really don't know why my website is not working, but if you go to the blog, you'll push this button and hopefully something will happen that isn't. Wait, is it going? No, it's not going. So push blog, you'll see a little search button. Type in hysteresis, Hysteresis, and you'll see part 1 and part 2. Obviously, watch part 1 first. Read that. They're 2 written articles, but I will do videos because it's an important subject. It's not just for VTS. Other people trading your own capital probably use something or should use something similar. But yeah, read part 1 and part 2. And I go through all the numbers and all that. It improves performance. And like I said, it also has the benefit of diversifying the triple portfolio again, because no point all 3 doing the same thing all the time. Okay, when you say sit on cash, are you on wallet cash or broker or cash equivalents? This is a good question. So if it's a significant amount of money, I would put it, for me personally, I just don't like distributions. So the box ETF, BOXX, really, really good. Now, if you look at my portfolio, cash doesn't play a very large role here. So we're not talking about a whole lot of benefit to actually buying cash equivalents. I mean, defensive rotation is the only strategy that goes to cash, first of all. So that's only 33% of the capital, but it's only in cash. I mean, these might be slightly deceiving. It says below 20%, but you got to remember that it's never really been below 9. It's based on rolling averages and whatnot. So we're actually only in cash about 20% of the time, if that. And that's 20% of a strategy that's already only 33% of the portfolio. And the cash equivalent makes about 4%. So you get the point. This is essentially 4% on 20% of only 33%. We're not talking about a very big amount of money. So if you just want to say, I'm in cash and it's literal just sitting in my broker account cash, totally fine. Do you want to chuck it in the box ETF? You want to put it in SHV if you don't mind distributions, SGov if you don't mind distributions, kind of all the same. What I would say though, and this is a good question, don't put cash in another asset. Because like I said, safety is safety. And some people think, okay, well, my money's in cash. Why don't I stuff it in bonds, right? No, because that might work sometimes, but there are times when bonds will also cost you a large drawdown, and we're only trying to be in safety, right? Don't try to make safety into a profit maker. Our profit makers are when we get all the green lights, all the signals are pointing the exact same way, be in this asset class. That's when we're chasing profit. All of the other times when it's ambiguous, we're just on the sidelines. We're just, not trying to crush it. This is good news. Site is working for you. Thank you for the confirmation. Something to do with my settings just today. It's never happened before, but I can't get into my own website today. True. Video games now are so cool. My kids play once in a while. I watch them for a few minutes and walk away, too time consuming. I try to get them to not play for more than 30 to 60 minutes. Well, that's the problem is you can do that if you want, but this isn't an exact analogy, but try telling someone that you can only do heroin for 2 hours a day. Well, you're not going to get very far with that argument. Once they start, it does its thing in your brain, and then there is no, okay, but 22 hours a day, nope, you can't do that. It doesn't work that way. And video games, even when I was young, little Super Mario Brothers bouncing around, like, I'm old. That's the game I used to play. They were addicting, and I lost hours and hours of my life, probably days weeks if you add it all up. I can't even imagine all the cool stuff that's going on now. Doesn't work that way. So I'm not telling you how to parent, obviously, but I just find that that's a big ask to let somebody play the coolest thing they've ever done in their life, but only for 30 minutes. Like, no, I want this for 16 waking hours a day is what your kid's probably thinking. So be careful with that. 0 is better than 60 minutes. Obviously, 60 minutes is better than 5 hours, but 1 minute is enough to break the dopamine system and be like, I need, just give me more of this, all this, shooting first person games. And it's so realistic. And I'm on there with my friends and I'm on a headset and all my friends, we're all a SWAT team or whatever it is. I'm aging myself. I don't know how the games work these days, but yeah, once you're in, you're in. So 0 is best. And, do with that what you may. Does USD go into any of your calculations? No, it does not. hysteresis showing 5 results. Well, in the title, it should say part 1 and part 2. If it doesn't, I'm negligent, and I'll change that tomorrow. But it should definitely say some type of clickbait nonsense, and then part 1, part 2 is probably what you're looking at. You may need to exit your silver today. Now it's down 30. Okay, well, let's all participate in this, because I did post this lottery ticket trade on Twitter. So, it's possible there was a couple people who followed me into this thing. Look at that. And I just have to be perfectly honest here, full disclosure. This account that you're looking at, this is live capital, of course. I've gone over this many times, but I have my long-term portfolio elsewhere that I don't ever show. I don't want anybody to know, watch my money. And I also, just because I'm kind of tech illiterate, I don't want to make a mistake and have somebody hack my account. But so I mirror this with my real portfolio as well. This is basically just sized based on this public account. This is our account that we track our live trades. So you can see the SVXY, the SPY, the QLD, the IBIT. I take the VTS portfolio live, and then our performance is based on the live trades from this account. So that's why occasionally you'll see something else slip in there, but I basically mirror everything elsewhere. So my trade here is up. This is getting somewhat exciting because I didn't think it would happen this fast. But so I spent $500 in this account. It's basically like a tiny percentage of the portfolio. But I got to say, I've got a pretty big chunk in my other portfolio, to be perfectly honest. So this is probably pretty cool. Now, as a general lesson in options trading, this is one thing that I will say, we might as well have it as a learning experience. Getting into profitable trades isn't actually that difficult. What is much harder is knowing when to get out, right? And this is especially true with something like long volatility. Notoriously difficult trade to know when to get off the train. Because of course, if it's making money, it means the market's crashing and you're holding something that could, if this is the big one, it could make tons of money. It could make hundreds of % profit. And your brain's going to be thinking, okay, well, this is it. This is Lehman Brothers collapsing right in front of my eyes. And so you might hold on. But you know that if the market reverses and just V-bottoms, all your money that you just made just crashes immediately. So this silver trade, unfortunately, I'm looking at it right now thinking kind of the same thing. Well, it wasn't that difficult to know that silver was going to crash. What's difficult to know is it going to crash down to where I need it 2 weeks from now? I want to expand a little more. This is nuts. Everybody knows that at some point this is unsustainable. And so I just did a little feeler trade, and now it's down 33% today. So is it going to go down to my number? Should I wait, right? Look at this. $500, it's up 3,700, max profit 9,500. So you can probably imagine the other trade that I have on is probably doing quite well right now. But my honest decision in the moment, you guys are all going to watch me make this call because it's basically 50-50. So for anybody, I don't know how many people are actually watching right now. What would you do? It's a good question, right? Because there's no right or wrong answer. If you exited now, when you put $500 on a trade and it's up to 4,000 in 2 days, it's up like 8 times the money. Like when you make 700% profit in 2 days, maybe don't be greedy, right? Maybe take the money. But on the other hand, it's called a lotto ticket trade for a reason. It was designed that if silver hits 65, I get paid a lot of money. And if it doesn't, I lose a tiny amount of money. So in that respect, you keep it on and you just see what happens. But you're all going to watch me do this. I think this little trade, look at that. The pink daily profit line is absolutely going crazy, which means I'm going to close this live now just to kind of demonstrate that exiting trades in a fast-moving market it's probably best to have some level of patience. So I call it the 30-second rule. So what I essentially do is I close the order. Let's just make sure that I'm doing this right. While I'm talking, it's a little bit weird, but okay. So what you're going to try to do is get the mid, and the mid is saying it's 43, but let's just say I'm trying to get a little bit more than the mid, right? And then you're going to confirm and send. Hold on a second. What happened there? That sound scared the hell out of me. I just jumped in my seat. I don't know what that was. What? This is nuts. Sell the vertical. Oh. Look at that. The pricing is all over the place. What is happening? It's down 33%, and I'm trying to close a vertical on the wrong side of the money. Well, why don't I just make an assumption at what price it's trading at? It's probably, I don't know, is it at 40 cents? I don't know. I do not know. Okay, what happened there? Yeah, that's good. I wanted to show the 30-second rule. I should have said 45, and then essentially what I would do is you wait 20 or 30 seconds. You go a little bit above the mid. So that was a long put option. The problem was I put a minus sign there. I wouldn't have the margin to do that. But you basically go slightly above what you're expecting to get, and you wait 30 seconds. And then you drop it down a cent or two, and you wait 30 seconds. You drop it down. So it was showing 43, and I should have done 45. It wouldn't have gone through, but you go down to 44, 43, 42, and you don't have to do it for very long. Option trading, you don't have to sit in front of your computer all day waiting for the absolute best price. You just make the decision in the moment, and you just get it done. So that's an example of a trade that easy-ish to get in, super hard to know what the right decision to get out. So once I log off to this live stream, I will get in and deal with the real trade and decide what I'm going to do. But that's pretty exciting stuff to be up roughly. What is that? I paid a nickel and I got 40 cents out of it. That's pretty great. Yeah, good stuff. So I actually should log off and take care of this. I should probably go close my other trade as well, because honestly, it could totally go down to 65, and then you'd be kicking yourself thinking, I should have waited. I would have doubled it even more. But again, when something works out this well, this fast, I'm not the type of person. I tell this to my friends all the time. Like, people say, oh, if you just would have held this and then waited. I'm not the type of person that does that. I'm reasonably conservative. So when I see the opportunity, take it. At the money SLV puts now 314. I'd roll down, lock in some profit. There's so many options, right? Leave it, because it started out as a lotto ticket. There's nothing wrong with leaving it. It's just saying, I'm going to look at it on February 20th and see what happens. You could sell half. You could sell it all. You could try to spin it off into some other type of butterfly of something. You could take half off and roll the other half and take an assignment of a position. There's a lot of things that you can do. But like I said, there are certain types of trades, especially very convex ones, where it's the getting out that's the hard part. So you just hit the moment when brokers pause the ability to trade on some platforms. Seriously? So that's what that buzzer, I thought the buzzer was that maybe I put in, because the bid ask was so skewed, I might have put in the other side and actually required a very large margin to close that position. And it just hit me with the, you don't have nearly the capital to do what you're trying to do here. But that would have been cool if there was like a little window of opportunity. Is that what you're saying? And I just happened to be like, it's closed. I'll have to watch the rebroadcast, because I didn't even look at the warning that it gave me. I literally jumped out of my seat. I have my volume to the max when I'm doing live streams. That was scary. All right. I think I got all the questions. So if there's nothing more, like I said, next week is an important one because I'm going to introduce like the next 6 or 7 live stream segments all in a row. So you're definitely going to want to do that. And again, like I said, feel free to join the community, take the free 2-week trial, download your free spreadsheet, mess around with it, ask questions, give me recommendations for things you want added to it. And if you feel like canceling after 2 weeks, you be my guest. But thank you very much, and I will see you all next week.